Okay, here is a little revisitation to one of my favorite topics, and that is option implied volatility. Now, first, I'd like to make a book recommendation, which is to anyone that wants to learn more about option volatility. It's called The Options Secret, or The New Options Secret. And the nice thing is, you get this book for maybe $10. It's about 300 pages long. Absolutely fantastic. So I'm just going to basically repeat what I learned from that. Okay, so first, to start off, implied volatility is a measure of the premiums, the relative premiums on options. So like SPY, and we're talking about the extrinsic value, so the time value. So say I have, let's pick one that we have right now, IDTI. We currently have a position in the August calls, and specifically this one, you see POS. Okay, so if I separate this into intrinsic and extrinsic, it says that intrinsic, it has 48-cent value. So that means if I exercise this option right now, I would get 48 cents 48 cents payoff. The time value is roughly 60 cents. So that means that there is no true value to it, it's just the value of time. So the implied volatility measures that extrinsic value on a relative basis. You see like 43%, 46%. The percents really shouldn't matter to you when you look at the option chain itself. The only thing you should look at really is, okay, on a relative basis, which ones are higher and which ones are lower. So on this one we see like these two at $1 and $2. These are extremely overpriced compared to the rest of the options because they have such a high implied volatility. So other things you could do, you could be like, okay, I want to get a good deal. So say I want to do a spread, let's just say SPY or something, and you want to buy one and you want to sell one. So let's take a look at puts. So you say, okay, I want to buy a cheap one relatively. I'm not going to say undervalued, cheap, and I want to sell an expensive one. So you say, okay, I'll buy the 128, which has a 20.90% implied volatility. And then I go down and I see that these down in like 114, 112 range, they're all the way up to 28. So I'm going to sell those. Okay, so that's the first thing I want to go over. Second thing, you can actually take a look at the implied volatility in Thinkorswim. You just go to the studies, and actually this should be easier. On the side there's something that says option controls, and one says stock indices average implied volatility. This will give you the implied volatility of a stock. So I'm going to go to Cabela's right now. Generally, implied volatility likes to travel within a range, and from that I mean when it touches all-time highs, it tends to bounce. When it touches all-time lows, it tends to bounce. So like if I go out to a 5-year daily chart, and always use a daily chart, we see that it always, especially in recent times, likes to bounce around this 35 level right here. So what am I thinking? It's very low compared to historical standards, so that means I want to buy options. Now say like, let's go 9 months back, and we're in the middle of August, everyone's panicking, and it's very high right now, and we see on a comparative basis that it hasn't been this high for a very long time. See if it's approaching any previous highs, and we get that it's approaching a previous high, this one right here, and we can say, okay, at this point it's relatively high, especially in the shorter term. So when I have a choice, I want to sell options, and that's going to give you a small edge when you trade. So for instance, let's take a look. Let's just say that this is at 70, this is at 35. I'm going to go into a price calculator for CAB. Right now I own a September call option. Go to a theoretical price calculator. So implied volatility is about 35 right now. theoretical price is $4.55. I actually got it at $4.30 this morning. So this is what we could do. So $4.55 is the theoretical price. We're going to make that implied volatility 70. So that's going to add 35% onto that original price. And this is how much of a difference it makes. Just because people are scared and they want to buy options, it jacks the price up this call from 455 to 736 theoretically. So yeah, you'd want to sell it. Now they're relatively cheap, so you want to buy them. So just things to think about as far as forecasting volatility. The last thing that I could go over would be historical volatility, which I'm going to overlay the implied volatility, make that a different color. I'll make that a blue. In general, implied volatility does not go above historical volatility bands. So by that I mean it generally will not go above the final part of the implied volatility. So if we see a spike right here, for instance, and we see that, I'm sorry, let's get this a little better. If we see that historical volatility is declining, expect implied volatility to decline very quickly. So even though it is slightly lagging, it can usually be good for forecasting short-term implied volatility movements. So see, like, historical volatility peaks after implied volatility starts moving down. This one starts moving down. Expect implied volatility to keep moving down. Once again, peak, keeps going down, keeps going down, keeps going down. So that's just a very rough way to forecast it. So I hope you learned something about playing the option market. Hopefully we can give you a little edge on trading.